When it comes to wealth building, we have so many asset classes we can invest in. We can think of private equity, private debt, hedge funds, commodities, or collectibles, of course, real estate, right? Um, Real estate is the most safest as well as widely accepted asset class in the market right now. That's why we cannot find any millionaire or billionaire who does not have real estate in their portfolio. But they do have a large team in general to do the due diligence on their behalf. They do look at every single deal before they invest in. But the problem is not most of us can afford to do the same. That means we need to look at the best we can do on our own, check everything what we can do. Uh, I have made some bad moves in the past. That's why I don't want you to learn from your own mistakes. It's best to learn from people who are done in the past in terms of taking their knowledge before you dive in. That's why I think we have Dan here to help us in terms of uh, one thing which I like about Dan because he come from both background. He's also investor who invests in real estate. That means on our behalf. On the other side, he raised funds for there are real estate projects that he can speak for on both front. That's why it's very important to talk to Dan. Dan, before I get into the details of questions what we have, why don't you introduce yourself in terms of your background, little bit of story about yourself.
Sure. So great to be here with you all today. Dan Kryzanowski in beautiful Austin, Texas. So sorry for my snow bunnies up north. I did grow up in Scranton, though, so I am used to cold and wonderful upbringing. I joke I played Little League on the same field as Biden, different years, of course, and then at college rode with Trump Jr. same years. So no more politics, but some of my upbringing here, and like probably a lot of us on this call, very, I'd say, standard, particularly pre-financial crisis, was with Mother Merrill Lynch, was with GE Capital. Remember GE, that company?
Yeah, of course.
Top
Capital.
rated in the world just 15 years ago. How time flies. Yeah, and once again, great experiences there, and maxing out my 401k. Somebody, managed my money, etc., and it seemed like the right thing to do. Well, I think I had little visions here and there, and then of course the financial crisis makes you take a deep breath. And from a lifestyle perspective, doing the reverse commute or commuting from Connecticut or Jersey, that wasn't going to fly with me. So we made a conscious decision to move back to Austin before probably the rest of the world sort of did. And I found myself instantly doing crowdfunding before it was crowdfunding. My first investment was a comedy tour. Haha. Great place.
Wow.
Yeah, great place if you want to do a write-off. So I remember sitting there. Our focus was on the Middle Eastern demographic, and I'm a Thunderbird MBA, soldier of the world, as they say, and thought it was great. Everything looked really good. Had a great time that evening, but I sat there with my wife and I said, you better enjoy these too. These might be $1,000 tickets. So yeah, and then $1,000 write-offs. But once again, real world MBA. Fast forward a few years, I'm co-best man in a wedding. And I asked the gentleman what he does. So I flip houses. I said, okay, what does that mean? He said, 15%. My ears perked up. And then he said, you can use your retirement dollars to invest. And it was just this light bulb moment that starts thinking about, wow, there's big pools of money out here. And, historically as a world society, everybody had it, internal. And then you had your top down industrial times, and then Wall Street. And now hopefully in some aspect, we're reverting back, or at least have the optionality to revert back, where folks can take back control of, frankly, their money to invest in something a little more closer to that. So this was the kickoff about a decade ago that pulled me in this journey to be, I'd say, a hybrid of an investor on the capital raising side, and then also knowing enough about the different vendors and folks that play in the space.
Wow, that's you started as your investor first before getting into raising your funds.
Yeah, and like anything, it's whether it's a product type, an asset class. I mean, for me to say, hey, I use my retirement dollars to invest in self-storage. Okay, what's a self-directed IRA? Self-storage. Now it's everybody loves. Oh, I know storage. It's great. No, not in 2014. That was a different world. For the average, I'd say, calling us the Joe Janes out here, for folks that were not intimately in the storage space. and I always think it comes down to a factor of also from education of like and trust.
Mhm.
Uh, Once again, and trust me, everybody, please like this 100 times over on Facebook and YouTube and otherwise. But trust is when money moves or people transact or people even take the time to learn from each other. So as the world has got once again from my blissful 15 years ago at GE to the world we're in today, it's become like anything. Time's our biggest asset, and then what do you look at? Who do you think about trusting? Who do you trust? And it's the underwriting side of it and everything. And then, of course, money moves. And then the scarier part is not only asking for money, but asking for folks to invest in somebody else's deal, I think, or recommending or naturally sharing your story. That's where I think, internally, outside of just being good hearted, you do have to have, I'd say, a fair number of reps and some expertise behind it
Yeah,
to make those sort of claims.
I think one of the common issue that I see in the market is like people or the fund who raise fund from investors. If they are very good salespeople, they can say the things that you want to hear, and then the materials everything to get you the money. But the high level, they look at IRR, holding period, what is the cash flow, and then the general terms. But that does not stop there, right? Because there's a lot of other things you need to look at um, invest in the project. So, first question: does the due diligence differ for different asset classes? You talked about storage, you talked about real estate, and then the commercial everything. Does it differ for everything, or is it common for everything?
Yes and no. So the easy answer, yes, is because yes, ultimately there's different asset classes, there's different project types from a new build to a development, different um, geographies, which can mean different laws, and particularly, if you're just putting in a little LP check versus more syndicating on behalf of a group, a whole lot of things. Is it a broker dealer fund? Is it a true off market? So, but I would say this is later on. I think first, I would say no, because the analogy, do you bet on the horse or the jockey? I think it's the jockey. And I think it's the one-on-one time. And I know Zoom makes it a bit more of a challenge per se, but taking the time to sit down, like I do think it's a point. I mean, on the investor side, we have an abundance of potential deals and people to invest in. And I like to say, I have a lot of gray hair actually. It's
I got no hair.
Yeah, well, I'm not right. It's who do you want to invest with? Who do you want to be with? And I think there's a lot of credence to that. And why do I say that? Because as an investor, you want your friends who you think you like and vice versa to invest with somebody that you like and think they would like, or at the very least, also, I should not just like, but also respect, because obviously money is moving here. But then this becomes a community to the point where it's the next deal or the next deal or the next fund. It's just a text message and hey, cool. Well, the money's here. Let's be together. Enjoy each other's time, share from each other to make this collectively better. That's the way. That's a circle I want to be in. Or if I drew a small LP check, that's how I want to get to know somebody. And the more I was at a Vistage, which for YPO, EO, Vistage is also, I would very generically say similar. I'm sure the Vistage people say we're a lot different, but uh, for founders of companies, CEO types, C-level. And the big thing we talked about yesterday was happiness. Is it happy what you're going to do? I think so. Whether you're on the investor side or on the capital raising or sponsor side, I think there has to be a happiness of who you're with, a nerdiness of the asset class and some of the intricacies in with it, and then is this sort of community? And we're all wired differently. Some folks might be very introverted and want, a big spreadsheet with 100 things, and that might excite them tremendously. And that's great. And that's a community. And I think that's a good, and that can be very healthy for investors and sponsor side. Other folks are going to want to go to the conference show and be together and do this and do dinner. And, if there's a comfort level there, then I think there's a whole lot that goes into it. And it makes it a lot easier to carve down. And even if you're more the right brain, well, it makes it more comfortable to look at the spreadsheets. And the other way, what are some of the other factors? Some folks, great example, if you're very left brain or you're thinking that, is it just one GP? Well, if there's only one partner, boy, I'm not saying that's a red flag, but there's a lot of questions why.
Yeah,
Um,
yeah, I
you
can
know,
see that.
sometimes you don't want to go too heavy down, Pollyanna or just heavy analytical. You do have to play the middle a little bit. And likewise on the investor, on the capital raising side, they always joke the smallest check is the biggest headache. I think there's, some credence that said sometimes the biggest check is the biggest headache, deservingly so. But yeah, I think saying no, I think getting to a point in your life, which is like anything, is tough as you're up and coming or building a brand or trying something new. But saying no to somebody in a respectful way quicker.
Yeah.
Uh, yeah, I won't say how many of my calls I take.
So,
It's a healthy thing, to be honest with you.
so let's say that I think you believe in the trust people. You like to invest in the people that you know much better in terms of the relationship first before investing. I think that's what you believe in, isn't it? But the question, let's say that there's a lot of marketplaces out there in the market. Even there's a lot of small funds and their marketplaces, including the bigger ones like Fundraise, all the things. They list a lot of projects in there, right? Do you recommend like going through those marketplaces where they don't get to know the GPs, they don't get to know the people? There may be a good deals in the market. In those cases, first of all, do you still recommend to invest in those deals based on the numbers, published everything, the team, background, everything, or just purely based on relationship?
Yeah, I think it depends on, frankly, how much money you have and how you divide up your chips per se. What do I mean by that? Let's just use indexing terms. If 100 is the biggest check you'll write for somebody or in any specific deal, if you can do the equivalent of crowdfunding for 1,000 or, one versus 100, 1% of whatever your maximum check might be, and you're actually going to learn something, not a vanity, hey, I invested in this and I get a free hat, or whatever. We're investing in real estate here, or a hard asset. But if you're actually going to legitimately learn something, so even if your little check gets you on, quarterly calls and you're working W-2 and this is going to be a good way to learn, okay, that might be worth it versus, if you did 100 blind chips, well, that's not really going to help your IRR portfolio. You're not going to learn anything. So it kind of comes down to, for these smaller ones too, does this still get you at the table with, using our 1 to 100, sort of analogy, with everybody else that's putting in, their maximum sort of checks, but you're going to have that access to like, oh, cool, there's only 12 investors in this deal, and I'm coming to pick a city close to where you live. Can the four of us sit down? And you're around. Even if you may invest 100 in different things. So let's say, hey, I'm a biotech guy, biotech, know nothing about real estate, but I can put a little chip for people that are real estate all day, and the two sponsors, and the six of us are going to go out for dinner. Yeah, that was probably worth putting in, I call it, a penny versus the full dollar for this sort of learning experience. That I think is okay. Now, do you get that from crowdfunding? Probably not, especially as certain brands have grown, and that's not a knock. It's just that you and I are tech guys. As you naturally grow from a tech side, that said, who do you want to know? It's funny, even, and CrowdStreet moved to Austin, so congratulations. I think the team is solid. What I've done though, outside of knowing some of the execs, let's say if I want to be an active investor on CrowdStreet, there's probably folks across the region, once a brand gets that large, where you can maybe meet with somebody or say, I'm thinking about real estate. Let me go to one of these regional shows and talk to somebody there. And they're not going to know everything about a specific deal, but I think you get the DNA of the company that's hosting these.
Mm-hmm.
And that said, like anything, if it's a hobby and if people have their play money that they like to trade sometimes, if this is still play money to a point and you can lose it and you're okay with that, maybe you still put in. But I always say, what is the learning you're going to get out of it? I had breakfast with somebody this morning, very bright person, very personable, great 9 to 5. And when he was sharing with me what he invested in crowdfunding, it didn't sound that good. And I know a deal that has not say performed as well, but has just been very delayed in dividends. And that was one of the best of his crowdfunding portfolio. So long answer is I'd be cautious to say I'm just blindly putting in, going back to my 0 to 100 analogy, 425K chips or 425 whatever chips, to say, okay, here's my, my 100 fully weighted portfolio, and assuming this is going to work out well. I'd be really cautious to do that.
So you mentioned the example, right? You met somebody this morning, and then
Mhm.
they mentioned about a deal from the crowd state. Um, let's say there are deals that doesn't matter. Like you said, pick one deal, talk to them, if they build a relationship, learn more, because it's not only help you in the current investment, you're gonna gain a lot of knowledge, information, so that you can make the next deals going forward. Knowledge is more important than anything else. But when it comes to the discussion that you had from the crowd state, what are the red flags you saw that made you thinking like that's not a good deal? One thing you mentioned about the delayed payment. So what are the things you can think of in general?
Yeah, and I only reference Krauty because they moved to Austin, so no strong opinion versus other folks out there. Although you can read the headlines of ones that seriously stop paying or maybe had some other shady stuff. Since we're on disclosures, I'll share also. Yeah, I'm licensed under BV Capital Series 7. None of these are recommendations. This is talking, as I said, with my LP hat, or if I do preface, this is kind of what you see in the capital raising side.
We'll
Uh,
definitely attach a disclaimer before the video, because that's a very important point. Everything what we discuss here is only the opinions, the knowledge, or not what you have. It's nothing in terms of advice what you should do.
And so to go back to your question, a platform is a platform. It's not, it's the conduit to give you as a passive investor, even if it's a higher dollar or accredited investor only, you have to think the reason why somebody is coming to this site. So if I'm a deal sponsor, I'm coming to this site because I want 100 people signing up. I want 100 new investors. I want to get my first 100 or my second 100 investors to sign up. And you can argue, well, what's vis-a-vis going through Facebook and LinkedIn and all the sales calls or whatever. The question here, though, is being that you guys, we never talked, and if there's even a hiccup in the deal, how are you going to communicate with these folks? And uh, do you then want to talk to 100 investors? So there's different ways to think about it. So one is just, hey, we got to close the deal, and I already have a marketing budget. I can put it on XYZ platform, and it's great. Some could be for, I don't say vanity metrics, but to hit a certain KPI. There's always those on the system. Others could be, behind you, here's my $1 million deal, but I have 100 million behind me. I want to try out one of these platforms that say they play with the big boys. So there could be different reasons behind it, but it's, you're taking a sincere effort, particularly if somebody just says, I'm busy. I don't want to be, 60-40 in the stock market. I'm working 80 hours a week in my W-2. I'm making buckets for pick your, big name company. And with my limited time, this is where I feel the only place I can put money, and let's see how it goes. Okay. It takes effort to then reach out to folks, which a lot of sponsors then may not do, because who are you going to call first? People you have relationships, people might be able to write a bigger check. So I think it's like anything. It could be a relatively big chevron from an education or exposure piece.
Okay.
But once again, just to be clear, and I've been with different tech companies, it's not the responsibility of the platform to facilitate the back and
They
forth.
won't.
It's just the transactional point of view. So I think that can be misrepresented at times, particularly if certain platforms are respected for giving large macro kind of advice, more, for example, on real estate or something. Uh, so what does all that mean then? So chicken and egg. Well, if you're busy and you're working a lot, you're accredited, you're well accredited. How do you get to notice some of these if you're just so crazy busy? I think what we're seeing um, is folks that, let's just take the tech world that we know well. A fair number of folks, and I had breakfast on Friday. Gentleman, he's Microsoft early retirement. Well, he owns a bunch of properties, and now he's doing multifamily. Who's he probably going to call on? His Microsoft buddies that he was in the cube with for all those years that have, I like to joke, more money than God. And so for them, it's like, hey, start putting in stuff. Eng Tang from Tozy does a great job. He was with Apple for over a decade. He led with education while at Apple to share with his colleagues. Now that he's going out on his own, he's literally, it's his colleagues, and then similar avatar and first level connection. So I share this because this is not, crowdfunding. This is direct to the investor and
Relationship based.
relationship based, and it takes a lot of work. But then putting on our tech hats, if you're adding the quantity of investors, well, does it merit having the IR team? It's like anything. If your growth is so high, sure. But if it's not, if you're becoming a little deal shop, it'd be tough to have calls with 100 investors a quarter, even if you don't have commonality and they're spread across the country. And, some folks, that might be their business model and be okay, a little more of an impersonalized. So there's different avatars sort of out there. And I think a big factor that we haven't talked about yet is, what is the goal for scaling? How big do folks want to get? And I know a fair number of sponsors that either do not want a hockey stick. Some don't even want a straight line. They just want to turtle along, which I do recommend. I don't think that's healthy on multiple reasons. I think you at least want to be a straight line growth, but they don't need to. And there's multiple reasons, why that they don't need to grow at such a pace. So they purposely do not staff. They purposely may not take small checks or go on to a crowdfunding, or if they do, they may not manage it. But then, the flip side, the investor says, wow, I put in my money, my trust. It just feels very impersonal.
I agree. So I agree. I see the point in terms of crowdsourcing is a different kind of means by itself, smaller team. That I have seen some deals in terms of, they say, always the reason they go to existing investors first, try to fill it up before you go to any other, because they build the relationship, everything from there. So let's talk about a little bit in terms of what are things can go wrong, right? I think, have you ever come across any deals, any scams by the GCs, or what are the people? Because sometimes it's good to hear what are things can go wrong, what are things happened, what are the ways the LPs lost. Those are the real learnings. People can take it away, so they can apply it. So if we can think of the ways it could have gone wrong, or some example that you can give us.
Yeah, boy, where to start? I would like to start a very personal example. We were pregnant, baby bliss, beautiful Austin day like this, and a friend, she was a CPA, very financially conservative, said, hey, you might want to talk to this gentleman. I go up a house a few miles away, was almost finished. This before everybody in the world was moving to Austin, prices were crazy, but I was like, oh, this is a layup. 3-month hard money loan, great. Fast forward, it wasn't done, but I'll be done in 3 months. Oh boy, 6 months in, this wasn't done. Long and short, I learned a whole lot more about Texas law that I never wanted to learn. And although at times I was very rich on paper from fees or whatever else, trying to play lawyer, just bad cookies, ultimately lawyered up, got out at 70 cents on the dollar. Good life lesson relatively early in my career, not just for my personal investing, but me suggesting to folks of who to talk to. So from this experience, I'm not the gentleman as much person, although he was a one-man shop. So for me, it's not a red flag, but it's something of caution why somebody is, in case they're a superior delegator and has a track record. And most folks aren't, naturally, we're not delegators, particularly if you're solopreneur. It's one of the toughest things is to become a delegator. That's one thing that I learned. Another thing, fast forwarding, now that everybody's doing it, deals are great, people are moving money quick, etc. We hear the typical 80-20, 70-20, or 70-30, which is usually investor GP.
GP, yeah.
Some folks are doing it opposite, and I think they're just thinking somebody is, and I don't know if they're also putting out crowdfunding, going full circle, but even outside of that, I think they're saying, yeah, when it's 80-20, well, it's 80 me, you investor 20.
Really?
But that's not the headline, of course, but that's what the fine print says. And is it illegal? No. Should the investor diligence? Yes. Can somebody probably kind of get away and be a little flashy in some circle and do it and go somewhere else? Yes. If they're paying the pref for a while, and the IRR presumably was going to be a 20, now it's a 14, is that heartbreaking? No, it sucks because it's not what you expected. But once again, I think some folks are, just because as the market's riding this wave, and it's not many, but I just say as a cautionary tale. And I would even think as money gets bigger, or it's a single, obviously this is where I'd say watch out for as an investor to the GP side, but just be cautious of sort of this and there's other different things with terminology. Return of capital, which I feel is a very powerful way to, on the accounting measures and,
Sure.
legal beagle of the deal. But, uh, that can be construed or implied a different way in the headline for what the fine print says, much like is it going to be cumulative pref or overtime, or oops, we didn't pay this year, sorry, the global pandemic, tough cookies. So once again, this is just as putting on my investor hat, what to watch on the GP side. Now, on the flip side, on the investor side, I know some folks, and you and I play in the family office circles, might really want that first family office check, really, really want. And, I like to say they're giving up 51% control for 49% of the check, or frankly, but what does that really mean? We're giving up 100% of the control because they have the majority vote. And some things to me just seem silly. Like my good friend John Manus, he just sold a very significant exit. I would guesstimate 9 figures. It's all public information here. Even once he was now pre-sale, but still pretty established, and everything that he was underwriting, he was on 10th, 15th, 20th deal. There were certain, I'd say, large outfits that said, well, we want to have the right to fire you and do this, and boom, boom, boom. And it's like, I thought you were coming to me because you're begging to get into storage. You don't really know anybody, and you tell me that other people have told you that I'm one of the tops, which objectively I would say is true. But, based off of this, it's like, let me just do my thing. Or I'm not asking you to be an anchor in a fund. I have multiple deals. Throw a little chip in here, even though your minimum is, X million. Like, once again, I go back to the concept of like and trust. If you want to trust just put on a little bit, or my 0 to 100, well, if you're $100 million shop, don't even put in a million, put in a decimal point of whatever, and get to know us. And so some of that on the sponsor side, and I think collectively, it's given, because I think some private equity and VC, even though VC is very different than what would invest in real estate, but PE has pushed and given somewhat of a bad name to the family office side a little bit. Although some FOs, I think, come with that private equity sort of mindset. Whereas when you and I, when you do talk to a lot of the families, it's extremely about the trust, about the relationship, and frankly, the return of their principal and the payment of the pref or distribution when, it's promised. So you have to think who's in the middle here, who's brokering, who's representing, and that's a whole different sort of animal. I think, especially when you move away from the regulated FINRA broker dealer world. Not saying that everybody's super clean and above board there either, but there's other things to think about folks' motivations of, how much, how quick, with who, with not who, different terms. Because like anything in a private world, much like Texas real estate here, I mean, it's still a very good old boy private transactions. You can write a bunch of different little things between it. I think in the private sponsor world, which I still think is a beautiful thing. So this is how, frankly, we transact in the world up until very recently. And I think we're over lawyered over everything, and it kicks a lot of people, pushes them to the side. But you do have to be. I think it's a beautiful opportunity to kind of have the blank slate and not be hyper regulated. Once again, Series 7, et cetera. But for some off market sort of things, but at the same time, be a little more diligent.
Yeah, that's for sure. When it comes to the GP structuring, underwriting, it's purely based on equity. That means, apart from the cash flows, people with the bigger return come from the exit, right? I think, is there any way that GCs can structure a deal that they can keep the investors until the cash flow and then before the exit, so that they can have the better return than the investors? Just want to see any red flags over there, because.
So let me answer it. Let me answer as an investor first, knowing that we're talking about the GP. As an investor, I'm either needing certain pref monthly, quarterly. So let's round numbers, 100,000. I need that 8 pref. I need that 2,000 a quarter. Great. And I want to 2x my money cumulatively in 4 years. It's the Olympics. We'll talk 4 years here. So boom, here we go. All right. If these are my 2 criteria, I kind of don't care if, well, I probably they could have paid me 10% in year two and then, a little bit less here. Or, they didn't tell me about, I know there's a bunch of things that go into it to say, let's say a similar example, I just want the 2X in 4 years. Well, if they're going to develop, and I've had deals where they purposely say, it's a value add, but we're not paying the pref self-storage because we're going to add 200 units in back and air condition and some boat and RV. All right, great. And I know that. I might even use my IRA money because I can't touch it anyways for a few years, choose what bucket to kind of come through once again, based on your mandate. So as an investor, trust me, I get a fair number of these calls where folks say, well, the split doesn't look good. Or what's funny, we have a fund where the back end is 50-50. Now, nominally, it's economically, if you and I did back the napkin, it'd be a 70-30. There's no acquisition fees. There's no disposition fees. It's a fund. There's no of the, the old hedge fund. There's no of the 220 per se. There's none of that too. And so for me as an investor, let's just say my hurdle, and some FOs, their hurdle on certain parts of their portfolio might be called, say, 15%, let's say. Probably the lowest hurdle, but for some folks, for certain portfolios, this works. As long as you get that 15 over, say, 5 years, that's good. You hit your hurdle. Now, whether you're getting a higher pref or not, or whatever at the back end, if I say, okay, 15 is my hurdle, for example, I want the GPs to be investor in line with me. I don't want them taking huge fees because some, some analyst plugged in a big sale number or a silly cap rate. I want this really, really conservative and say, wow, you guys did really well. I still want you to keep the lights on, of course, but then, you're confident that you're going to operate throughout that. Actually, a majority of this 15 or half of it's going to come from cash flow that you're going to pay me throughout, not kind of, hey, we hope for the best sale at the end. So I think sometimes investors get too myopic on, okay, what's the split? Trust me, growing up in the self-directed world, UBIT, UDFI, I'm like, guys, stop, different conversation. And then going back to your original question, how do the GPs do it? Well, they can incorporate fees. And I think seeing both sides of the table, an acquisition fee, there could be different ongoing management fees. There's a lot of things that go in. Something as, hey, I send you out a quarterly newsletter and I do that internally. When you think about how to do the GP split, you always hear about the three parts: who found the deal, who did the debt, who did the equity. I also think it's fair consideration who is doing the ongoing, not the management of the asset, property, I should say, but of the asset, of the investment, the communication with investors, the marketing. I think that these folks having skin in the game, once again, to keep the lights on, but this is where some fees might want to come in. And, frankly, most investors, it's, once again, as long as that IRR is there at the end, especially when it's a deal like, boy, been trying forever to get into Texas self-storage, and it's, it's an 18 versus a 19, Okay.
I think your point is focus on our perspective, what we want in terms of getting out there. There are additional fees, everything. There are different reasons over there, but focus on, as an investor, what I want in the cash flow.
Yeah, and then as a GP too, I mean, sorry to cut you off, but it's just, it's funny, right before our call here, I had 3 emails where folks said, I don't like the back end split. I don't do 50-50s. I don't do this. I said, okay. How about I get, and I don't have the liberties because this is, I joke, it's FINRA. It's all left up, FINRA. Trust me, it's compliant. But what it is I'll take just an extreme for argument. This is not real, but let's call it, like a 110 and, or a 90-10. But I'm going to take a lot of fees to cover myself. We're still going to get back to the same IRR, but I'm going to take my fees. But guess what? If something does not go well around years 4 or 5, or the market naturally says no, like in the macro, the market stops. Well, yikes, that's it. So maybe because, you and I have been in the tech world a little bit more is, boy, the true unicorn for me is when you invest in a startup, if they were able to pay monthly or quarterly dividends, like that would be amazing, and still some sort of exit. I think real estate folks, partially because the majority of investors have either not see where the music paused or stopped in the last 10 to 15 years, or their day job is working for a PE shop or somebody with buckets of money, and they think it's their money when it comes to personal, or kind of their mindset is, um, there's a fair amount of work to ensure that you're being paid this sort of thing. And there's another gentleman here in town in Austin, and he says, for a certain point, I don't do, 80, 20, 70, 30. I do waterfalls anymore because it doesn't motivate me. I need to be motivated to know, for example, let's say a very rich multifamily here in Austin where things are crazy. I need to know after, a 22 or 24 IRR, it has to be a 50-50, or, if it goes over 30, I'll even switch the teeter totter. And for somebody that's what, and he's long many deals, he's exited multiple times. So I think I like the concept of so kind of coming in the middle of this is, I still think fees, you don't want to set yourself too short, even if the partners are well off. You have to look at each deal or fund almost independently for the work that's going in. So I would suggest fellow GPs take some sort of fee structure throughout, fair, maybe not too much, not too little, and then still be investor aligned. But at the same time, I love the concept of the waterfall. I think we have to move into that, and selfishly too, as a hedge, I can put on my GP hat now, my sponsor hat. Let's say inflation really, really picks up. Obviously, you're going to have a lot of costs and a lot of headaches, and that you probably want that thing. So, and that's crazy scenario. The IRR is a 90, in 3 years because inflation went crazy. Well, there's probably a hell of a lot of headaches you had as a GP dealing with that. You had to raise your rents concurrently with that, everything else. You probably don't want to be stuck with the sort of 80-20. So like anything, like any cycle, I think once the music pauses a little bit, and, those that have, had the competency, the character to rise above, I think there's going to be a good pause, and folks are going to reflect to say, either we like the waterfall, we want you to have fees, and frankly, we want you to have more of the risk along with it.
So, in the market condition right now, because the cap rate is shrinking right now, and then rental market is expanding in terms of more renters are coming in, compared to what is the current better deal structure on average in the market for investors? So we talked about 80-20, right? Let's talk about what is the average IRR investors can expect, or also the return end of the holding period and the return from the holding period on average.
Yeah, I mean,
just a watermark in terms of anything below, I think it's not good. Anything above is a great deal. Something like put a watermark on it. What is the average numbers on cash flow, IRR, exit, and holding periods?
So I'm going to talk more as an LP that's pretty networked in circles here, with a little bit more of a preference to Texas from the standpoint of the information I'm sharing. This is going to vary greatly by asset class, geography.
Sure, of course.
So for example, multifamily, let's rewind 2 years. Saying I have an 820 deal, an 8 pref 20 IR seemed pretty reasonable. Things were rich. Not everybody was in. Not everybody felt, I'm going to buy a lot of folks doing their first deal with 50 to 100 doors. They have 6 partners. They're not going to make that much, but that's a really big win. And I share that because you, like anybody, you're very hungry for a resume, or just to get repetition space. Think of Tom Brady, just get me to play, or, on third string, give me a few things in practice. Or to be like, well, even though and it's 6, when I heard 6, I'm like, geez, man, are you going to make money off this? But I realized he's trying to get to a certain amount of assets or doors. Then you can really go to your market to say, hey guys, here's what I've done. And this, not just in Austin, but I think across the country, I think folks that, VP of a tech company, I think is a very good avatar that is moving to this world, that they want to move out to the 9 to 5. So with that, in addition to just the general mindset of folks focusing more on real estate for both the percentage of the personal asset, but also percentage of your personal time. What do? You're going to be a smaller sponsor. Like, shit, I saw this 22-year-old kid because he had the idea, and frankly, the gumption to say, this is what I'm going to do with my career early on. And, in 2019, and he's long 300, 400, 500 doors right now. I share all that. And then naturally, once again, this may differ in California, which I've only been to once in the last 2 years. Everybody moving to Texas, of course, cap rates are going to go down, prices are going to go up. So in good faith, a headline, an 820, I'd be like, whoa, so you think you're going to pay 8 pref off the bat, and you think you're going to you feel really confident about 20. Okay. I've seen more of a 616 sort of, which I think is fair. Now, can they beat it? Do some folks have folks beat this and, pay, I'll call it quarterly bonus sort of things? And yes, have folks that have sold within 18 months. I mean, Ryan McKenna, one of his headlines was, it was wonderfully silly, but right place, right market. Plus, he has a great track record, amazing operation. There's many folks I can say that about also. And the ROI math is just, well, I sold the whole in 18 months a lot quicker. Sure, you're going to have a pretty
very short time.
Yeah, from that standpoint. But I'd say folks say, listen, we're going to do this and we're going to play it out to 3 to 5 years. I think there's a lot of uniqueness about the team, the track record, how you found it. And some of the stories have to be comical. I'll genericize a little bit, but let's just take student housing. Well, unlike multifamily, if you don't lease up student housing a few months before, you're really tough cookies. Like, these puppies are sitting empty. They're sitting pretty, but they're sitting empty, and you're not going to. What does this mean in this scenario? Well, you can't pay your mortgage. It goes back to the bank. Does the bank want to own a student house property? It's versus, vis-a-vis everything else in the world that they're doing. Maybe not. If they have somebody that's local with expertise that they know and trust, that's willing to buy it, that seems like a pretty good sort of transaction right there. That's kind of a wild scenario. It's a true story. So with that and verifying, once again, we talked about, the jockey, the track record, everything else. And stuff happens sometimes. And maybe, in our true story here, this was a one-man shop effectively on the GP, or was doing too many GP things at a time, or too many types of deals and forgot about this, or they were out of state. Oops. Sometimes things happen. So with that, these are some of the scenarios where, even with that, a sponsor that would say more than 20, I'd be like, I don't know, man, being a little cautious about this. But I still think these are the sort of very unique. And once again, this is not a mega raise. You're saying we're doing a fund on these. These are very sort of smallish sort of one-offs, relatively lower dollar amount raises, where it's just a very, very, very unique scenario. And even with that, I'd say the wise underwriters would be cautious to state anything more than 20. I think it's in case it's going to be inflation that's driving that number up. I'd be cautious to do that.
Sure. Still, the multifamily is the best asset class right now, or because we have a lot of things in terms of Flux e-commerce space is getting ramped up right in the market right now. Also, you talked about storage as well.
Yeah, I mean, when you said e-commerce, I think you're saying, without saying it, industrial.
Industrial, yes.
It's funny, it's been industrial, much like storage, I say in the early 2010s, that we're on all these top 5, not top 10, top 5 asset class within real estate list. And industrial, once again, using Texas as, what I know, because it's local, a lot of people, a lot of stuff, more people, more stuff, people making stuff in a business-friendly environment. Port, Mexico, politics aside, stuff is coming and moving. And naturally, how we are doing stuff, it's this whole last mile industrial thing. You do want to be quicker, et cetera. You may even want warehouse space, because I know folks, supply chain stuff, they want that. They literally want it in here, and we'll pay for our own person. We'll have a warehouse here because we want this quicker. So costs don't go up 40%, and we have to store it somewhere else and get it. So these are just some of the factors that are making something like an industrial, I think, very attractive and almost a bit more predictable. A lot of these tend to be 10 to 15-year leases with 5 years with the rent sort of built in. I would hope most of them have what I call, the kind of the oh shit clause, meaning that if stuff really goes, inflation's a unique thing to talk about in real estate. And I'm thinking of my comment a few moments ago that, okay, sure, prices go up, or inflation goes up. That means rents go up, but your costs are probably going to go up too. If you have a team, how much can you pay folks $15 an hour if inflation goes double digits? In good faith, you can't, or if you don't, there's going to be a day when folks just aren't going to come there.
Yeah.
And a lot of not so nice stuff might happen, even if it's a Class A multifamily. So anyways, why I share some of this, very bullish on industrial. On the flip side, not to go doomsday, but we are kind of talking a little dark here, is I think residential, there's a lot of meat on the bone. I don't think vis-a-vis it's going to be uh, great for society as a whole. I think the delta to even get into a starting house, the New York Times had a great article on San Diego. I forget if it was La Jolla or somewhere similar, that somebody said, hey, we're looking at we want to move into our place, house on an older house on a plot of land, little plot. Somebody outbids 30-40% above it. What do? They put an A, B, and an ADU in back. Same family comes say, can I buy one of the A's or B's? No, we jacked up the equivalent of rent double. I really want to live here. I like this area. I like this neighborhood. Okay, you can pay rent now. So if it's what's most important, let's say if the in-laws or somebody lives close by and you want to be in the school district, almost feels like an episode of 90210 where you have to rent the smallest apartment so you can go to Beverly Hills High School. I think this is happening. And the second thing you're seeing here is folks, and I noticed this in Austin, even going back a few years, that our great music venues, some of them were just shut down with the exception of 2 weeks a year. Why? South by Southwest comes, somebody pays buckets of money, you get rent for a year in 2 weeks. Okay, that it's a good little party if you're invited or if you want to come by, but then the other time it's like, there's nothing there. It feels like almost a ghost town when there shouldn't be. I think the term in Miami is like the cocaine tower sort of thing. I think you're seeing that coming more to like a main street, or it's just for the bachelorette party sort of thing. So it's even a crapshoot too, especially if your view of for folks with younger families here is I want to move somewhere where it's going to be family friendly. It might seem that way, but in 2 years, if all these folks sell out, you're in a very quiet, an eerily quiet week, and then a hardcore party, bachelorette sort of thing. I've seen that in Austin, just a few miles away. I think this is a unique sort of bellwether, a whole lot of not in my backyard sort of stuff. Why do I bring all this up? On the residential side, outside of, that's my soapbox. Outside of that, for just black and white economics, I think, if you think of Maslow's hierarchy of needs, air, water, food, shelter. Okay, well, we don't want to be running around naked, but you don't need, 100 pair of Gap jeans or Levi's or, drink Coke, Pepsi all the time, boom, boom, boom. I think I think collectively as an owner class for both multifamily and residential, it's like, let's take more of the typical 30% you pay for rent or mortgage and bring this out more. There will be a point where it's unsustainable, but I do think it's going to go. I still think there's significant upside, I think. Now, in many markets, you're buying high and selling higher, but I don't see how this doesn't play out. Now, what's the silver lining? Self-storage, of course. So,
Self-storage.
and why I share here, because most folks can't do storage. First of all, storage 101. 4 out of 5 facilities are owned by mom and pops, still 40,000 to 50,000 plus. If you find them and it's the right place, right time for these folks to retire, it's great. So they probably haven't raised rents. They probably, don't ever have a new management, or it's not sophisticated. Your bump on day one is tremendous. And if you know kind of how to do things over the first year, 18 months, you're sitting really, really good. On the side, for folks like, hey, I had a COVID baby, great. Well, and I'm working from home. Boy, if I don't want to feel like I'm a super hoarder, but I really need this stuff, such as like my kids' winter coats, but I need this for my office and my tax forms because my CPA says don't throw them out yet. I can either find a bedroom for an extra 1,000 somewhere, or I can rent storage for 100, using round numbers as an example. But that's kind of a ratio in terms of what you would pay for the equivalent size of storage versus if this was your space.
And also the market, people are traveling around the world and working remote offices. I think I heard that is propelling the storage market, because I heard some single people just like close the lease, put the stuff in the storage, and then they're working every single country, traveling around because they're working remote. I think that's propelled. But the question is it going to sustain when the things settle down, come back here? That's the question I'm trying to ask myself in terms of storage. Is very good stage right now because of things.
I think it will. And once again, storage is still a sub market. It's a very 1-3-5 mile loop. And the thing is, it's always been there's the 4 Ds. I touched on decluttering, which I think is the 5th D now, but there's always a place, death, divorce. There's always life that happens. And from a price perspective, even if you are, you have a bunch of kids, things are a little bit tight, you're middle class, for what's left of the middle class or lower economically, it's still probably less than your cell phone bill. You know what I mean?
Of course, yes.
It's and obviously it's not your rent or mortgage, it's not your car payment, it's definitely not your health insurance. You keep on going down the line, and it's like, all right, yeah, you could cut it out.
Mhm.
Um, and then, I mean, that's a tough moment, frankly. I know for the Christmas tree that we put there 1 month a year and take it back, we should never do. We should buy a new tree every year. Even if it's electric tree, we don't. But that said, it's been good to kind of cycle out and keep that sort of space. Plus, because I'm in the industry, I always want to use the product that I'm potentially promoting or suggesting folks to go into. I feel it's disingenuous, not to have money in the game per se as a consumer, particularly for something that's consumer facing. Uh, but no, with that, I still think it's folks. I call it the skis versus surfboard. When do you trade out becomes seasonal? I think there's some benefit for that mentally too. As the world is becoming less, fortunately in the U.S. we're recognizing more religions, more cultures, more everything. I think kind of like feng shui, folks recognize the benefit of a clean space. So, storage, love it.
Thank you. I think that's a lot of information we covered in terms of the start of the due diligence. We talked about asset classes, we talked about cities, we talked about bodies as well. That's good. So, is there any advice you can give for the first-time investor who wanted to do as an investment?
Yeah, I would say just do it. So much like my analogy with like and trust, there's going to be a certain point where, for you to be an investor, you're going to write a check. So, my left brain folks out there, there's a certain point where you're going to learn so much more when that check is written versus just kind of, living by kind of just, analysis paralysis. On the flip side, I wouldn't be blind, after a bender or at 3 a.m. and think, hey, I'm going to, let's say you have $100 that you want to ultimately invest and you're going to put like 95 in your first crowdfunding deal. No, don't do that. And even if it's your friend that you trust and like or really like what they're doing, I would still say at the max, keep it of, frankly, probably even 10% of your bucket that you assume you're going to invest in going forward. I would, tread lightly with that. But write that check and see how it plays out. Also, as a win for me, my first check was with a gentleman that flipped houses. So I received my return, although I chose not to get the monthly. I could have. I think it paid off in 7 months. That was relatively quick. I'm like, oh, that's cool. And then I did it again, and I think I doubled it or added a zero.
That's good.
Get there. And he's never missed a payment, and he's a great guy and great team and such. Has a partner also. It's 2 guys.
Mhm.
So I'll hit by a bus analogy. Also, what one is good at, the other one is not. And so I would also, I'd all go back to that too. If somebody's doing, especially, they're a one man or one woman shop and it's their first time, even if they're your best friend, that maybe not where you want your first check to go.
Thank you, Dan. I think with that, I think we will learning from today. I think whatever it is, first investors, you can do all the due diligence, investment relationship, start with investment as soon as you can. Learning is the first thing you're gonna get more in addition to the returns. That's your 2 cents. That's why I read it. Thank you, Dan. I really appreciate it. Thank you, guys.